You're listening to ChooseFI Radio. The blueprint for financial independence lives here. If you're looking to unlock the secrets to financial independence and early retirement, you're in the right place. Stay tuned and join a community of like-minded people who are getting off the hamster wheel and taking control of their lives in the pursuit of financial independence. ChooseFI, your home for financial independence online.
All right, guys, super excited to dive into this past week's episode and discuss our takeaways on the ultimate buy and hold portfolio and honestly, Paul Merriman's incredible content that he brought to the show. And to help me with this, I have my co-host Brad here with me today. How you doing, buddy?
Hey, Jonathan, I am doing quite well. Yeah, we actually just got back from San Diego and the world premiere of the Playing with Fire documentary.
That was incredible, man. Obviously, we've been talking about this documentary and this world premiere for a while. The documentary has been in the works for over 2 years now, just a little bit over 2 years. But in my wildest expectations, I didn't expect to have as much of a blast as I did at San Diego.
Yeah, I mean, the entire thing was a celebration. It was a celebration of Scott and Taylor and Travis and their entire team. It was a celebration of the FI community and what we've built here. I mean, Jonathan, we had about 250 people show up and spend the entire night with us, really. It was just this extravaganza. It was amazing. I mean, to see Playing with Fire June 1st on the marquee, it gave me chills. It honestly did. It was just such a cool night.
My biggest takeaway was, like, I had watched the documentary ahead of time, just I'd gotten a chance to preview it before we went there. And my biggest realization was you should not watch this on your couch alone in your living room. For right now, if you have the opportunity, you need to join the financial independence community. You need to watch this, go to the movie theaters, go join your local community, watch this movie with a group of like-minded individuals. It will transform not only your viewing experience, but the impact that it'll have, the takeaways that it'll have, the camaraderies that'll be baked around that experience. It is worth every penny of the price of admission.
Yeah, and it's just a movie, right? So we're not talking breaking the bank here, but yeah, you're absolutely right. I mean, there must have been 50 times throughout the movie where people just laughed out loud. And it was awesome. I mean, this is ostensibly a movie about financial independence, but yet it was emotional. It was hilarious. It was everything. And it was, like you said, just a really great time to spend it with other like-minded folks. And Jonathan, to your point, getting together in person. There are many of these other events that are going on throughout the entire country. We actually have a couple of major screenings coming up here. Next Thursday, June 13th, in Washington, D.C., you and I are going to be there. Scott and Taylor are going to be there. I'm sure many other bloggers and podcasters that you've heard of. And there are actually still some tickets left as of when we're recording this. So if you're in anywhere within the Washington, D.C. area, definitely grab a ticket for that. So all tickets can be found. We actually set up a short code. It's ChooseFI.com/TUGG, TUGG. Jonathan, there are some other major ones coming up in Seattle and Atlanta.
Yeah, what's interesting about both of those, so the Seattle and the Atlanta, in particular Seattle, I think Paul Merriman might actually be there for that particular screening. How incredible would that be?
Yeah, that would be super cool, especially right on the heels of having him on the show.
I guess what I wanted to get across, we were actually talking with Scott and Tug, and apparently the way that this screening tour has come together in all the time that they've been doing this, they say that this is one of the strongest screening tours they have ever seen. And when they look at the why it's happening, they really believe it's because of these ChooseFI local groups that are able to get this message, get this documentary in front of the exact people that are looking for it with such ease. And then just a shout out to those of you that are actually adminning the local groups. They said just the ease of working with you guys, the friendliness, the helpfulness that you're bringing to the table has just taken their enjoyment of this process to a whole nother level. So it's kind of like total alignment. And we're so appreciative for them making this as simple as possible. But I just wanted to continue to encourage our audience. Join your local group. Find a way to go to a community screening. Go to ChooseFI.com/local. Make sure you're part of that local group. If there's already a screening there, go to that screening. Be a part of it. I promise you it will be worth your time. And if there hasn't been a screening proposed yet, just say, hey guys, do we want to do this? Now, there is a minimum number of tickets that need to be sold in different cities in order for the screening to actually happen. And there's a few dates that are coming up a little bit more quickly. So for those, I just wanted to go ahead and give you guys a shout out. On June 20th, Grand Rapids, they need 17 more tickets to be sold in order for that screening to happen. In Albany, New York, when I got this note, it was 31 more tickets that they needed to be sold by this past date. I'm pretty sure last time I checked that is down to just a handful. And so make sure you go there and join them for that screening. That's in Albany, New York on June 20th. On June 27th, Pittsburgh, they need 11 more tickets to be sold by the 17th in order for this to happen. Nashville, Tennessee, their deadline is by June 19th, and they just have a dozen or so tickets that still need to be sold. Portland and Vancouver, Washington, their deadline to meet the ticket threshold is June 24th. Long Beach, California, Las Vegas, also June 24th, and Honolulu need a couple dozen tickets sold by July 3rd. So the farther you push back the screening, the easier it is to hit this, but we will do whatever we can to help support this just because it is that important. We think it's going to be that beneficial for you in a local community to be able to go to a screening and see how many other people are on this same path. And that was one of the biggest epiphanies that I had when I was watching this, and really not even epiphany as much as it just solidified it. The path is different for all of us, right? We have access to the same levers, the same options, but it's not going to look exactly the same. But the mindset is there. If you know that other people are in pursuit of this goal, that they view this goal as important, it will validate the own choices that you've made and make this journey so much more fun. So community is a big part of what we are trying to accomplish, both with the local groups and really with this screening tour.
And Jonathan, like I said before, this is an emotional journey for Scott and Taylor, the actual movie. I mean, it's so interesting how we always say this is a choose your own adventure, and we're all coming at it from different points of view. You and I in particular, you, as you call yourself, you're the reluctant frugalist, right? This is not easy for you. You're following the path to FI in service of this goal of a better life, of a freer life. Whereas I am just frugal by nature. That's I've actually, if anything, kind of loosened up over the last couple of years, which is interesting, right?
Yeah, you're the average of the 5 people you spend the most time with them dragging you down.
No, but I mean, the funny thing is I don't think it's dragging down. Like, it's opened my mind up to spending based on value. Like, that's not something that was in my vernacular 4 years ago. It just simply wasn't. And now that's how I live my life. And I think that's fascinating. So in the movie, this was really difficult for Scott and Taylor, and especially Taylor. I think that's an extremely valid point of view. That is not my story, but when I see it, I understand. And it also makes me more empathetic for people who are pursuing a path to FI that it just doesn't come naturally to them.
Yeah, I love that. That you're absolutely right about that. The thing that you view as so obvious may not be obvious to someone else. The thing that you view as a natural path may not be natural to someone else. And what that means is they're largely not going to do it the exact same way that you did it with the exact same enthusiasm that you chose it. But if they can see something on the other side that's so appealing that it makes all the things that they want to have now kind of fade, then it allows you to make a choice that'll lead you and your family to a better outcome. And I think that's what we see with Taylor over the course of this movie is just her values really become crystallized. They get focused. And as a result of that, it allows them to make decisions that, you know, maybe a couple years ago would have looked out of reach or so extreme that she wouldn't even have considered it. The last thing I really wanted to say about this documentary screening tour is, you know, get a ticket for yourself. Absolutely. But bring a friend, right? I mean, think about, is there anything that you could do that have a larger impact on your neighborhood, your friends, your social circle than to bring them to a documentary like this where they realize that you're not the crazy one. There's literally thousands of people in every city that are on this path with you. What sort of impact does that have on your social circle? And how much better is your life as a result of even getting that conversation started? You don't have to hide this aspect of yourself. You don't have to put these decisions that you're making inside of some sort of box that you only bring out when you're in the safe space. You can actually open up the door to this conversation. Bring a friend to the documentary. This is more than just financial independence. The whole point is to spread this message as far as we possibly can.
Yeah, and Jonathan, my final note actually on this screening was just a huge shout out to the San Diego ChooseFI local group. What Jennifer's done there, what the entire group has done there is nothing short of amazing. I mean, they literally, I think they have 800 plus people in that local group, and they get people to turn out. I mean, we had hundreds at this screening. We had multiple events where there were 50 to 100 people easily, just off the top of my head. It was a good time. I mean, this is a true community. They're getting together outside of these meetings and just spending time with each other. So I am just blown away. And I mean, really, the reception they gave us was nothing short of amazing.
And Brad, a big piece of that is people raising their hand and saying, hey, I'm here to help. This is important. I want to see these talks happen. I want to see these different meetups happen. What takes these events and these local groups to a whole nother level is the people behind the scenes that are willing to say, hey guys, I want this to become a reality in my local community. I'm willing to lend a hand wherever I can. And actually, if I could just take a half a second and put a shout out to our local community, we need your help. There's still a couple screenings where we're really trying to create this fantastic, awesome experience. And Ed, who we've mentioned on the show many times, and his wife are jumping in along with Jennifer to help organize these. But we need people on the ground in the local cities just to help us with just some organizational pieces that need to come into place. So in particular, for the cities of Washington, D.C. coming up on the 13th, and Seattle and Atlanta and New York and Richmond, Virginia, here in Richmond, Virginia. If you want to help us organize this screening, just tag me or Ed or Jennifer in the local group that you're in. We really would love to connect with you and get your input and insight as we try to organize this event and put together really something awesome for the community. All right. Well, let's go ahead and dive into this past week's episode. And there is so much to cover here, and there's so much going on, which is why it's almost hard to focus. But I think the place to start is the ultimate buy and hold portfolio, and really kind of mesh that with something that we've been long talking about, which is the simple path to wealth. My larger point that I came away with is this is the same path. This really is the same path. The concepts, the precepts, the playbook that's been kind of laid out for us, the why of doing this is mirrored verbatim by what Paul is saying. And there's some slight nuance there. And we're going to dive into that. But one of the things that came to my mind is, Warren Buffett says S&P 500. He says, when I die, I want you to put 90% of my assets into the S&P 500, which is the largest 500 companies inside the United States. J.L. Collins, when he really came up with the simple path to wealth, is really a way to communicate to his daughter what he would like her to do. Hey, I know I can't get you to listen to 10 minutes or 20 minutes or hours and hours and hours of investment advice, but if I can get you to do one thing that will guarantee a wonderful outcome for yourself and your future, if I could just get you to put as much as you can into VTSEX for as long as you can, you'll be very happy with that outcome. And that's a slight pivot on the Warren Buffett S&P 500 in that J.L. Collins says, ideally, I'd like you to get a little bit of extra exposure. So I really want you to invest in the total stock market index, all the publicly traded companies inside of the United States. And that, I believe, Brad, is just over 3,000 companies. So it's an added layer of diversification. You're getting almost an extra 2,500 companies on top of maybe that initial 500. So J.L. Collins is a fan of diversification, as are we. Paul comes in and says, I love the simple path to wealth. I love the S&P 500. I love the idea of keeping up with the market and just focusing on reducing your fees. And I'm a huge fan of diversification. In fact, I'm a diversification fiend. If I can, is there a way for me to get, instead of getting 500 companies or getting 3,000 companies, what if I could just get 12,000 companies? I want to own them all. The winners and the losers, I don't want to miss anybody. And I recognize that a lot of them are going to be dogs, but by expanding my horizons and truly getting every company, then I'm going to have the best chance of getting the most return over a longer period of time. This is what the academic studies say. I don't have any problem with that. I don't know exactly how we're going from 3,000 to 9,000 companies. Where are we finding these extra 9,000 companies when VTSEX covers the total stock market index? Brad, maybe you can help me, but I like diversification and I like doing it in a simple way and I like doing it reducing fees. And I think that was my biggest hangup was I need the simplicity. Like I don't want to abandon simplicity in order to get all this extra diversification. But I think Paul kind of laid some groundwork for us to start entertaining this idea.
Yeah, agreed. And Paul said the lower the expenses, the better the likely return over the long run. And I mean, that ties exactly with what we've been talking about here at ChooseFI for 2+ years and what J.L. Collins has talked about significantly in the simple path to wealth. Fees matter. They just do. So if that's the backbone of this, and Paul Merriman talks about diversifying just that little bit more, and I think he started with that ultimate buy and hold strategy, but maybe in light of this conversation he had with John Bogle, actually in his office, Bogle told him personally he was making it too complex. And now Merriman's newest strategy and what he's advising is the 2 funds for life. And now to me, this makes more sense. So ultimate buy and hold, you look at it, there's 8 to 10 different funds in there. It's just, it's a little bit too much for my own brain, frankly. But with this 2 funds for life, it really simply is the target date index fund and then a small cap value fund. So Paul Merriman believes that will outperform just the standard either S&P 500 or total stock market index fund over the long term. Now, obviously, that's something I personally have to look into. Before meeting him, I had not even entertained that, but it's very interesting and it meets my criteria of being simple. So I really appreciate that.
Paul, in his own mind, says, my bias will always be the ultimate buy and hold portfolio. But based on this epiphany that I got from Jack Bogle, that I'm making it too complex, that was like one of those awakening moments for me. Then I went back and Chris and we put together this 2 funds for life, which essentially accomplishes the heart of what I want to accomplish and does it in a much simpler fashion. Now, my question, which I posed to William, who is our Chief Technology Officer here at ChooseFI, was, is there a way that we could basically replicate the ultimate buy and hold portfolio in all of its glorious complexity and do that in a simple way, right? Is there a way that we could use the fact that technology has never made things easier than it is right now? Is there a way that we could do that, making it so simple that you just basically set something and forget it? And so for that, that's the entire premise of this next segment on the show. And with that, William, welcome back to the ChooseFI podcast.
Thanks. It's great to be back.
First, man, I'd love to get your feedback on this episode. I know you listened to it ahead of time. What were your biggest takeaways?
It was great to hear Paul Merriman introduce his buy and hold portfolio. I've long thought that asset allocation is one of the more important decisions and doesn't get talked enough in a lot of communities. So it was great to hear another approach beyond the 100% one fund portfolio.
Yeah, and William, one quote that Paul said was, and remember that better return doesn't come because of greatness. It becomes because you took more risk. I thought that just jumped off the page to me. And I'd be curious to hear your thoughts on that and how that ties into asset allocation generally and for you specifically.
Sure. Although he's totally right. I mean, you don't get something for nothing. So any extra performance is generally because you're taking on either more work or more risk. One thing to be cautious of is just because you take more risk doesn't mean that you're necessarily going to get more returns. So there are a lot of risky assets out there, such as, say, penny stocks, where hugely risky, but you're certainly not guaranteed a commensurate amount of returns for that risk. So in order to get the extra returns, you have to take on more risk, but just taking on more risk is not sufficient enough to get the extra returns.
So
if that makes sense.
Yeah. I have a question for you. So, if the total stock market index fund represents about 3,000 publicly traded companies, Paul says that he's, with the ultimate buy and hold, he's owning around 12,000. Where is the difference of that magnitude coming from?
The ultimate buy and hold also includes foreign allocation. So in addition to all the US-based stocks that you would get in the total market index fund with VTSAX, he's also including the developed market stocks. So things like Samsung, plus emerging market stocks. So companies that are working out of, say, India or Brazil and are on their exchanges are also included in his portfolio.
Interesting. Now, I had a question there is, we had asked JL Collins back in episode 36, it was kind of an Ask Me Anything format, what he thought about, owning additional international funds. And JL Collins' response was twofold. One, got it covered because most of the major companies that are included in VTSAX have international exposure. They have operations in other countries. And also by targeting international companies and international index funds, the expense ratios were traditionally a little bit higher and you had a little bit less transparency. So for a couple reasons, he said, I really feel like I'm getting 90+% of the benefits by just staying inside of VTSAX, and I don't really feel the need to expand outside of that. What are your thoughts on adding a significant international bent to your asset class?
I personally do. The same theory that justifies VTSAX or a total market index fund, you don't know where the winners are going to be. And that justifies international exposure as well. I don't know whether Samsung is going to be outperforming Apple. And so I'd want to capture the possibility of Samsung's growth. I want to capture the possibility of the next new internet fad being something that comes out of Russia as opposed to out of the United States. The idea that US companies have international exposure, while true, isn't the reason why. I mean, Apple has exposure into lots of different products and Google has exposure into lots of different products and markets. That doesn't mean that we don't also invest in all the other tech stocks in the United States. The idea isn't to capture where these profits are coming from. It's to capture the profits of the companies in these other countries. So it's not about revenue collection or where the revenue comes in. It's the companies that exist in those countries is why you invest in international stocks.
So, William, this actually ties into something that Paul had mentioned that I've kind of always struggled with. So he's saying in a study, roughly 1 of 25 public companies hit a home run, and these brought most of the returns in the entire index. Whereas the other 96, he said, brought in roughly the same return as like T-bills or a money market, around 3%. So really the hard part is picking those individual stocks. You have to find that 1 in 25, the 4%. That's Paul's contention. But as this ties into what we were just talking about, is it getting access to just more and more companies? Like, is that the key? Does it benefit us, I guess, just in this very narrow regard to have 12,000 companies versus 3,000? Or by virtue of it being cap weighted, are you getting such a tiny little exposure to that 11,000th company that it almost doesn't really help them much?
So yeah, the issue of the cap weighting and the exposure that you have to some of the small companies is an issue. I mean, you're not going, if some podunk company that's on the market grows by 50%, you're not going to capture that whole 50% growth if there's only a minuscule amount in your funds. Now, as that company continues to grow, of course, that's going to become a bigger and bigger portion of the fund. So eventually an Apple might bubble up to the top. So one of the other criticisms of the international funds is the expense ratios and how much it costs. I'd say that's a historic relic. It used to be really expensive to invest, like 0.5% index or 0.5% for even an international index fund as an expense ratio internationally. And that'd be kind of a pricey index fund. Nowadays, you can get international exposure very cheaply. I mean, for like 10 basis points, or even on Fidelity, they are offering a free international fund. So the idea that international exposure necessarily costs a lot is also a relic of the past, I believe.
Yeah, and William, another thing that jumped out to me that Paul said was he wants to give equal weights to all his different asset classes that he has in the ultimate buy and hold strategy. So this is really asset class weighted versus cap weighted. And I'd love to hear your thoughts on that strategy.
Yeah, I like it. I like having a higher allocation towards small caps, which, although are present in a total market index fund, they certainly do not carry a lot of weight, simply because by very definition of cap weighting, you're going to get a smaller amount of companies that are smaller. By adding his 10% allocation of small cap funds, specifically just small cap, then I like that approach.
Yeah, and William, small cap value. So that's the one that Paul has hit on significantly for his 2 funds for life strategy. And does that jump off the page to you? Like, as a really an uninitiated investor, I have no way to determine, is that the right approach? Is large cap value? Is small cap growth? I just ultimately have to trust on some level. And like, that's not good enough necessarily for me. Like, is it good to just have one, like small cap value? Do we genuinely believe that's going to outperform? Is that going to get us, like he said, that extra 0.5%, where I think he said something like an extra 0.5% is a life changer over an investing lifetime. I'm willing to expand my horizons beyond just index funds or VTSAX or whatever it may be. But I'd love to have at least some sense that this really is going to outperform. Like, have you looked into this?
Yeah. And quite honestly, I own small cap value funds personally. There's a good level of research on what's known as factor-based investment. So factors, it started off with like 3 factors and 4 factors. Now there's, I think, like 100 different factors that have been identified. And it used to be that with stock picking, any overperformance of someone's portfolio was just established as being alpha, the skill of the person who was picking the stocks. More and more, the research has shown that what's actually happening is that that portfolio is exposed to a variety of different factors that have justified the extra performance of that portfolio. So having smaller companies and picking smaller companies that have more room to grow within the market, that is a known factor. So that's the size factor. And there's a quality factor and momentum factor. And there are a variety of factors, and the number of factors have grown quite a bit. And small cap value is an allocation type that has multiple factors going on that have both been established as being more likely to outperform the broader market, according to research.
And to be clear here, we're talking about what is essentially an index here, right? So small cap value, we're not talking about finding one tiny little company and investing in individual stock and just hoping. So this really ties more into the strategy that J.L. Collins talked about when he talked about the broader index, which is it's self-pruning in essence. There's unlimited upside on the winners. And I guess the losers only make up a tiny little portion anyway, and they can only go down to zero. Whereas the winners, it is ultimately endless, right? So we're talking about buying thousands of these little companies and hoping that really, in essence, a tiny little fraction of them outperform wildly. Is that pretty close to spot on?
Yeah. It's pretty close or spot on. Pick one, Brad.
No. Hedging my bets here, John.
That captures it pretty closely. It's important to recognize that, as with most any other funds out there, small cap value is a corner or it's a segment of the total population. How that segment is defined varies from fund to fund. So there are small cap value index funds, and there are small cap value active management funds, and there are small cap value individual stocks. Now, whether someone buys individual stocks that happen to be in that sector, that allocation or the grouping of small cap value stocks, or whether someone invests in an active management fund or an index fund where the index is defined by some programmatic division of the market, like all companies that below a certain market cap are considered small cap, and all companies that have a price to earnings ratio of XYZ are defined as value, and the intersection of those two sets become your small cap value index. So there are multiple approaches to get that exposure to small cap value. Obviously, I'm consider myself mostly an index investor, so that's how I gain my exposure to those factors.
One of the points that he made when he was pitching the idea of this asset class, the small cap value, is that historically over time, this is the class that outperforms. But recency bias here, the last several years, that has not been the case. And so someone that is currently on a VTSAX strategy or an S&P 500 strategy and has now become relatively comfortable with 15% plus returns year over year over year, that now is saying, should I diversify out and maybe change my mind and try this? The reality is individuals that made this decision to do this maybe 3 or 4 or 5 years ago have been getting maybe 6 or 8% returns on this small cap value when, the S&P or VTSAX side by side has been just crushing it, totally crushing it. And I only say that to say that somebody's thinking this right now. Like that somebody is absolutely, why would I move from something where I'm just crushing it to something where year over year I'm making less, almost half. The biggest thing Paul said, the biggest thing that'll mess you up is if you switch course. Like, it's fine to bring in new information, make a change, but if you get emotionally tied to those returns and you don't stay the course 5 or 6 or 7 or 10 years from now, you're never going to see the outcome projected by the academics 40 years from now.
Right. And that's a really important thing. It's also important to realize that in the recent past, VTSAX has done, or just market cap weighting has done really good because most of the returns have come from like 5 stocks. The classic FANG stocks, Facebook, Amazon, Netflix, Google, I think Microsoft is in there now. But those stocks are where most of the growth for VTSAX has actually happened. Historically, yeah, you have cycles, and we've recently been in a cycle, actually since probably around the end of the Great Recession, where growth stocks have just really grown. I don't think that something is fundamentally different in our economy that will allow that to continue forever.
So, William, you talked a couple minutes ago about the different options potentially for small cap value, and that whereas the total stock market index fund, or certainly the S&P 500, it's pretty obvious what's going to be in those, whether you're in Schwab's version or Vanguard's or Fidelity's or whomever's. But with small cap value, I did some research because this sounded interesting to me after hearing Paul, and I didn't know where to start. Obviously, we don't give investment advice on ChooseFI, but how does someone, do you just type in small cap value into Google and just hope for the best? I mean, where do you suggest people go, and what are they looking for specifically?
Okay. It's probably worth acknowledging the fact that Merriman, or Paul, has actually done some of the research for his own. He has actually not just asset allocation choices, but actual individual fund choices. So if you want to buy into the official ultimate buy and hold portfolio that Paul has set up, that's going to have a fund that's selected automatically. I believe he actually has multiple funds depending on what brokerage you're a part of. The other approach is just to look at a particular fund, or basically what type of fund company you're already using. So if you already have a good allocation in Vanguard with VTSAX, then you might want to look at Vanguard's small cap value fund and see if that matches your needs. So the decision isn't necessarily find the optimal fund, it's get exposure to that sector of the market. Most of the funds are going to have fairly equivalent returns if you're looking at roughly apples to apples. One might be a Red Delicious, one might be a Gala.
I've never heard anybody go into depth on the apples to apples comparison.
Tell us more, William. That's all.
Huge fan of Honeygold myself.
There may be some minor differences, but mostly you're going to get an apple if you're going to buy from whether you buy it off of Fidelity or whether you buy it off of Vanguard or whether you buy it off of Schwab. There'll be minor differences, but overall, the differences in the asset allocation is going to be the bigger difference for your portfolio.
Yeah, now one of the things I wanted to ask you about was actually, is there a way that we can use technology to make this almost as simple as the simple path to wealth? And in particular, I know you and I have talked offline about M1 and what a fantastic tool this is. But one of the things I asked you about last week when we talked about this episode is there a way that we can basically replicate this and get most of the benefits from the ultimate buy and hold portfolio and just have it basically automated using M1?
Yeah, and that's a resounding yes. So M1, it's been mentioned several times on the podcast before, but just to recap, it's a brokerage or investment platform that instead of recording transactions and saying, I want to buy X number of some fund, with M1, you actually define your asset allocation in terms of pies, and that's percentages of your portfolio that are allocated into individual stocks or individual funds or even other pies. So you can say that you want your portfolio to be, let's say, 90% stocks and 10% bonds, and then the 90% stocks can be composed of another pie that says 50% in VTSAX and 50% into whatever. Let's say you're a big fan of some company, you can invest in individual stocks even. And then your 10% allocation can be divided up across short-term, medium-term, or long-term bonds, or however you want to define that allocation. And then as new money comes in or as money comes out, those allocations are maintained by the platform itself. You're not actually having to go in and say, okay, I want one share out of this fund and one share out of this fund in order to keep your balance. That's something that the platform takes care of for you. And it's the ideal platform for dealing with multiple funds or multiple allocations like the ultimate buy and hold that Paul has defined.
Yeah, and ultimately, William, we want to keep our brains out of investing decisions. This is a really cool platform. I have to say, you and Jonathan have been talking it up behind the scenes here at ChooseFI, and I am so used to just investing at Vanguard that it didn't really cross my plate. But in light of this Paul Merriman thing, I decided to open up an M1 account, and I had set up my pie, and I didn't even fully realize that when I put money in, so I initiated like a $5,000 transfer, and it was automatically invested. I actually expected it to sit there in cash, but that's not how this works. You set your investing goals beforehand, and then when you transfer money in, it just immediately gets purchased in those percentages, right?
Depending on what you want to do. So there's an option as you're looking on your browser there at the top. You can say auto invest on and off. You can say auto invest over a certain amount. And I mean, it does give you the micro controls, but to your larger point of getting my brain out of it, maintaining asset allocations, this is one of the biggest criticisms of, and I was kind of pushing back on Paul just a little bit on this. Like if you start making your investment strategies like following a diet, you're going to have similar results to the vast majority of the population when it comes to dieting. It's not going to work. It's not going to stick. You're going to fall off the wagon, right? Every single time you go to the fridge and you try to make a choice, whatever, that's a single point of failure that can have a snowball effect. But if you can remove all of that and say, this is what I want to do when you're in your, imagine like on a diet, right? When you're most motivated, you say, this is what I want to do. And then you create an automated playbook to just execute on that for as long as you're doing it. You're going to get the results that you're looking for. It's incredible. And that's what you get with this M1 platform. You get to say, when you want to put all that bandwidth into this project and you say, this is what I want to have accomplished. I want to have this kind of complicated asset allocation maintained over an extended period of time. When something gets out of whack, I want to come in and buffer up the rest to always keep it in balance. You tell it to do that, and then it just does it. That's unreal. It's amazing. And the fact that it doesn't charge you for that, there's nothing like this out there.
One of the really nice things about M1 is that decision is boiled down to, do I want to put money into the portfolio? Do I want to take money out of the portfolio? Once it's defined, you can set up either automated transfers, and the platform itself will define or will decide what to buy in order to stay in compliance with the plan that you've set up. So if you've set up a plan that follows the ultimate buy and hold portfolio, for example, it will say, hey, look, this wedge or this pie is low, and it will buy shares of that pie or whatever the underlying shares that represent that pie. It will buy the appropriate amount based off of you just giving money to the platform or you providing money to the platform.
Now, while at a macro level, this is an interesting conversation, it's probably not useful by itself to that user that says, well, I just want to do that. So I asked William if you could put together like a screenshot tutorial of what it would look like to replicate this kind of ultimate buy and hold mentality inside of M1. What did you end up coming up with?
Sure. So giving credit where credit is due, Paul actually has defined his asset allocation for the ultimate buy and hold as M1 wedges or M1 pies. One of the nice things, and we haven't actually mentioned this, is the platform allows you to share these pies. So you can define a pie and then other people can use that pie in their portfolio. So we've set up a tutorial, and I believe we'll be setting up a web page that links to Paul's pies. His pies are a little bit more complicated based off of the division between stocks and bonds. Everybody has a different kind of risk tolerance. So he tries to address the risk tolerance question within his pie allocation. So he has pies for if someone is a 50-50 stock bond investor, this is the ultimate buy and hold for that person. What I've done is take his 100% equity pie and then also define our own pies based off of his funds that he's allocated in his percentages for, and basically create a bond pie. So in order to basically get the benefit of the M1 platform, only thing you need to do is define your top level portfolio and say what your desired allocation is between stocks and bonds. And for your stocks, you define with the ultimate buy and hold if you want. And then for the bond, you'd use the other one. And you can choose your own risk tolerance for your own ultimate buy and hold portfolio. So if you say you're a 66% equity, 34% bond, you can do that. Whereas the portfolios that Paul had set up are like targeted only at like a 10% interval.
Yeah. So to our audience, we are an affiliate with M1. We did create this tutorial series for you on our website. if you want to start using this platform for yourself and your family. To do that, just go to ChooseFI.com/M1. And the other point that I wanted to make is, and this was a comment that we got from Matt, one of the problems historically with this ultimate buy and hold portfolio, because this is weighted in various asset classes, is it's very difficult to get a perfect 10% in each of his 10 different asset classes. And he says it's definitely worth diversifying to the extent that you're able to, but many people are going to be unable to construct the quote unquote perfect portfolio. This M1 tutorial will basically allow you to do this in such a seamless way and help you maintain these percentage. It will help you maintain your asset allocation percentages, over time. So let's say, for instance, you're in your more aggressive years and you're 100% equities. And then as you get older, you're bumping it down, and maybe you're 90-10 and then 80-20, et cetera, as you get on your glide path to retirement. On an interval basis, you could just log in M1 and say, going 40, I feel like I'm more of an 80-20. I'm more of a 70-30, et cetera. But then instead of it triggering a sell-off, you can sell off if you want to. It gives you a way to optimize for tax loss harvesting and capital gains harvesting. But if you don't want to go through that process, you can just use new money to fund the other assets until you get back into range, always doing it in the most convenient way imaginable. So again, if you're interested in that, just go to ChooseFI.com/M1. The cool thing is, as you add in new money, it will actually rebalance to maintain that asset allocation percentages.
Right. So you can trigger a rebalance at any time. But one of the nice things is it doesn't necessarily have to be new contributions. It can also be it also is the dividends that come from all the other pies get allocated into the pie that is in most need to grow.
And William, I'm curious, are there any additional tax implications as far as selling funds, capital gains? Are there commissions we have to worry about? Talk me through that.
So M1 actually does offer IRAs. So if any transactions that happen in an IRA, of course, are tax deferred or tax free. Within a taxable account, I would say that you probably don't want to be doing selling, because the platform doesn't matter for your tax obligation. The IRS doesn't care what platform you use.
Don't you realize we're using M1?
So if you're in there and constantly hitting the rebalance key, which will sell off some of your high winners and buy your laggards, you're going to end up having a lot of taxable transactions, and you're going to end up having a tax drag. But M1 does allow you to rebalance through the new money that's coming in to the portfolio, either new contributions or dividends or any other money that comes in. And by allocating that new money cleverly, the way the M1 does, you avoid the tax hit of selling while also bringing your allocations back in plan or back to the plan.
William, thank you so much for coming on the show and chatting with us about this incredibly important conversation.
Had a great time. Thank you.
All right, Brad. So we started this episode talking about community and talking about the screenings. I think the larger purpose for this documentary is to spread the concept of financial independence, but really at its core, financial literacy around the world. All of us say, why didn't they teach this to me in school? Why didn't I learn this? Why am I now finding out about this in the age at 30, 40, 50, beyond? If only I had heard this sooner. And so right now we have kind of this rare opportunity to actually act on that and kind of watch out in a very significant way for the next generation. And Ed, who works with us here at ChooseFI, has been in talks with Junior Achievements about partnering with them to bring in people from the local groups to go to what's called finance parks all across the country. And we actually did one, me and you. We joined our Washington, D.C. local group to do it. It was an incredible time. The feedback from Junior Achievement was that they had never seen such an engaged group from an organization. I mean, it makes an impact. So when you care, when you really want to get this across, it comes through to the kids. And I just think about the inflection points in your life. One of those in your life was the first time you ever saw a compound interest calculator, right?
Yeah, it absolutely was. And yeah, you just never know when you're going to be that inflection point in someone else's life. And yeah, we're trying a beta program here. As Jonathan said, Junior Achievement has never seen a more engaged group from an organization than ChooseFI. In the limited ways we've interacted with them so far, they have been blown away and they want to partner with us more significantly. So what we're looking for are people to step up, an admin to step up in a few cities across the country where they have these finance parks. So we've already had people step up in Seattle, San Diego, and St. Louis. So those are a go. And we have 9 other cities that we've highlighted where we need people to step up. So they're Denver, Phoenix, Atlanta, Detroit, Charlotte, Milwaukee, Minneapolis, DC, and Richmond, Virginia. So send an email to feedback@choosefi.com with something in the subject about junior achievement, and we'd love to get moving. This is really, as Jonathan said, this is a huge thing going forward because financial literacy is so important. And if we in the financial independence community can help this at a broad range, help students all across the country, I think we've really got something. And Junior Achievement is actually going to be working hand in hand with us. So what's going on June the 13th, Thursday, June 13th, they're going to be holding 2 briefings for our community. So this is going to be at 12:30 p.m., both Eastern time and Pacific time. So basically, so people can get this during their lunch hour. Just go to ChooseFI.com/JA for Junior Achievement. ChooseFI.com/JA on June the 13th. And just get involved. If you're in one of those cities, honestly, even if you're not in one of those cities and you just want to be involved in Junior Achievement, they have organizations and schools that they work with all throughout the country. So if this is something that pops off the page to you, go to ChooseFI.com/JA for more information.
All right, my friends. So unfortunately, that is going to bring this episode to a close. Now, as you know, we like to finish every episode by doing a drawing for a copy of a book that we have found useful. There's 3 books that we offer. The first is J.L. Collins' book, The Simple Path to Wealth. The second is Dominic Cortuccio's book, Design Your Future. And the third book, Vincent Puglisi, Freelance to Freedom. If you want to enter the drawing, all you need to do is just go to ChooseFI.com/iTunes, follow the instructions there, leave us a short written review on either iTunes or Stitcher, and then send us an email to feedback@ChooseFI.com letting us know that you left a review and what screen name you left it under. We give away 1 book for every 5 written reviews that we get, and we announce the winner on the Friday Roundup. Brad, how many winners do we have today?
All right, Jonathan, we have 1 winner today, and the winner is Al. And he said, Tim Ferriss borrowed from Jim Rohn, saying you are the average of the 5 people you most associate with. I am happy to include Brad and Jonathan in my 5. Thank you both for the work you do on the podcast. I'm educated, inspired, always entertained. Keep up the great work.
All right, my friends, the fire is spreading. We'll see you next time as we continue to go down the road less traveled.
You've been listening to ChooseFI Radio Podcast, where we help middle-class America build wealth, one life hack at a time.